A little bit of movement in the offshore and onshore Chinese yuan. You have these open market operations that are helping bring down the funding costs for some of these banks. The Markets Live team says, you know what, this is good for bonds because ultimately it will bring down some of the yields, and that has implications for futures across the board. In fact, why don't we check in with the pulse in global markets? GMM Go on your terminal. A story then in the Asian equity session that tells a very potent pickup from what we saw in the S&P 500 overnight. A little bit of downside coming through in Japan, down 0.7%, but upside on the ASX 200 to a tune of 0.25%.
What's the yen doing? Is that your protection trade? Citigroup's positioning alert is the highest since last July. Active currency funds, they're adding long yen positions. Let's get your first word headlines with Deborah Mao.
Menace news of French President Emmanuel Macron has launched his great debate on reforms, trying to convince his critics that he's not an out-of-touch elitist. However, he stumbled at the very beginning, accusing some poor people of being feckless and simply messing about. Macron offered talks with leaders of the so-called Yellow Jackets movement after widespread protests that have dragged on for almost 2 months. The European Parliament is celebrating 20 years of the common currency. The euro is used by 19 of the EU member states and was initially introduced in January 1999. Among those marking the occasion were former European Central Bank Chief Jean-Claude Trichet, his current successor Mario Draghi, and the EU Commission President Jean-Claude Juncker. However, the euro fell sharply as Draghi said that the eurozone economy is weaker than expected, hurt by rising geopolitical uncertainty. Warning against complacency, he said significant stimulus is still needed to help the drive towards stable inflation, and the bank's rate policy continues to provide support. Sources are telling us that Renault is ready to remove Carlos Ghosn as CEO. They say the board has concluded that a decision is urgent after Ghosn failed in his latest appeal for bail in Tokyo. He's been in jail for 8 weeks now, accused of financial misconduct. Renault directors are expected to meet in the coming days, and some reports say he'll be replaced as chief executive, regardless of the case against him. The founder of Chinese tech company Huawei has broken a years-long silence to dismiss allegations that his firm helps Beijing spy on Western nations. Ren Zhengfei denied helping official espionage, saying he has no regular contact with the government. Ren spoke with his daughter facing fraud charges in Canada, and Huawei embroiled in the biggest crisis in its 3-decade existence. Global news 24 hours a day, on air and at TikTok, on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Deborah Mao. This is Bloomberg Manus.
Deborah, thank you very much. Theresa May's Brexit deal suffered landslide loss in Parliament, and she now faces a confidence vote later today. Her plan was defeated by 230 votes, a margin far greater than most had foreseen, and the worst for any government in modern history. However, following the loss, she struck a defiant tone.
It is clear that the House does not support this deal, but tonight's vote tells us nothing about what it does support. Nothing about how, or even if it intends to honour the decision the British people took in a referendum Parliament decided to hold.
Anne-Marie Horden has been tracking the events throughout the night in our London studio. Anne-Marie, good to see you this morning. What happens next? Defiant Theresa May.
Yeah, that's right. Not just did she lose 230 votes, Manus, but 1/3 of her party, more than that, voted against her deal. Today is when she'll face this no confidence vote that was brought to the table by Jeremy Corbyn, the leader of the opposition, the Labour Party. But she's likely to survive this. Her own party would have to rebel against her, and already the DUP says they're going to back her. So the question everyone has on their mind is what comes next? Well, May says that she's going to put her hand out across party lines and try to come to a consensus that will hopefully get them to the finish line. She's likely to head back to Brussels as soon as Thursday, but the European Union is fighting, playing hardball really with May. They're saying that the UK lawmakers need to come to some sort of decision amongst themselves, and they don't want to renegotiate, and they're calling this really a disaster, what they saw last night take place in UK Parliament.
Anne-Marie, I'm looking at some of the safe havens, U.S. 10-year, gold, and some others, and we didn't see any shock waves from what happened overnight. So there wasn't much of a move on that front. What asset class, what assets are you looking at where we might have seen more of a reflection?
Well, everyone really is watching the pound because that is what any sort of political news will shake sterling. And what is astonishing is, Manus, you said this was the worst defeat in modern history, the worst we've seen in a century, yet the pound ended up gaining on this news. Right now, we're back to levels pretty much before we came into this vote, but the pound actually gained on this news, and part of that is because May is signaling she's willing to work with all members of parliament, and many are saying this takes the idea of no-deal Brexit off the table. I want to also show you about what FX traders are pricing in at the moment. They're saying we can see sterling dollar 135 if we get the possibility of a second referendum. The lowest they're seeing is 115, and that would be if we were to get a no-deal Brexit, and that is just 10 weeks away. There's one thing I also want to point out. After this vote, Philip Hammond and some other finance chiefs got on a call with British business leaders, and the exasperation from the business community is really clear. Director General of British Chamber of Commerce says there are no words to describe the frustration, impatience, and growing anger amongst business around 2.5 years of a high-stakes political roller coaster ride that shows no signs of stopping. So May needs to come to the table in terms of her members in Parliament with Brussels, but as well, she's facing up against the business community.
Well, those are certainly strong words. Anne-Marie Horden in London. Great job overnight, Anne-Marie. Joining us now is our guest host, Monica Malik, Chief Economist at Abu Dhabi Commercial Bank. Monica, always good to see you. Anne-Marie outlining what comes next. The possibilities of a second referendum or no Brexit at all. These tail risks, it would appear this morning, are rising. Would you concur?
Absolutely, I would. And if we even look back the last 2 months, what we've seen is Parliament taking more control, putting some lines down for the government. And I think the size of the defeat really raises expectations that the Article 50 negotiations will have to be extended. And also the comments by Theresa May last night that she'll bring cross-party MPs into the deal indicate that going forward, the chances of a no Brexit, a no deal exit are diminishing, and that's reflected in the pound. But at the same time, we expect to see a lot of volatility, and until we have an extension of the negotiation period, risks remain, and that is also being priced in.
Monica, you mentioned volatility, and we've built a chart exactly around that theme to really show the move that happened overnight. Our clients can pull this up, GTV Go under Bloomberg. I want to flesh out the European angle on this because the Commission, the head of the European Commission, Mr. Juncker, saying that time is almost up. The French president not giving any signs of hope from his end. He says it's internal UK politics. That's what it is. Are we going to get anything from the Europeans at the last minute?
Well, I think unlikely at this point. I think what they don't want to do is be hostage to every single political move, and we are expected to see a lot of moving forwards and backwards, and as Theresa May said, while there is consensus within Parliament for a no to avoid a no-deal Brexit, there's very little clarity of what the consensus is for a deal. So I think what Europeans would want is some sort of consensus coming out of the UK and then to work around that. But ultimately, we believe that it's not in the interest of Europe for a no-deal Brexit, and we at the end do expect a pragmatic view from Europe. But at the moment, I think they will try and put a hard stance and give UK the message that you need to sort yourself out and then come to us when you have a clearer idea.
A clearer idea, I suppose everybody would like to have. British businesses sound very frustrated. You heard that from Anne-Marie. Consumer spending dropped in December, the fastest clip in a long time. Monica, are we seeing the reality of Brexit, I suppose, intransigence really play out on the consumer?
Absolutely, and in all parts of the economy, really. Consumer, investment, business uncertainty, and the longer this drags out, the more frustrating and the greater impact it will have on the economy. We've seen a grind down of economic activity, and there is broad-based frustration outside politics that you know, sooner or later this impasse has to end, and I think that really remains the critical point. You wouldn't want an outcome where this continues indefinitely, and that again returns to the question of, do we return to new fresh elections or a second referendum? Recent polls ahead of this parliamentary vote showed that the feeling outside, the largest support outside politics, was that if this deal didn't pass, we should have a second referendum, and I think that pressure will build on the street as well.
I mean, the folks at Mizuho say that basically traders are dismissing the possibility of the Prime Minister losing a confidence vote later Wednesday. Monica, we still have a lot to get through. Monica Malik stays with us. In fact, let's get you a bit of a snapshot of what's coming up. We'll talk about the billionaire founder of China's Huawei. He breaks his years-long silence to dismiss accusations about his company. We're going to have the details next.
But up next, China injects a one-day record amount of cash into the financial system ahead of the Lunar New Year and following a raft of dismal data. More on that story next. This is Bloomberg.
Let's get you a quick check of the latest Business Flash headlines with Deborah Mao. Deborah.
Yusuf Dubai's biggest bank has beaten estimates, boosting full-year 2018 profit by 20%. Emirates NBD reported higher lending and lower loan loss charges and is recommending a dividend of 40 fils a share, the same as last year. Full-year net of 10 billion dirhams, or $2.275 billion, compared to 8.3 billion dirhams last year. Snapchat's parent says its chief financial officer is leaving, but insists the move is not due to internal disagreements. A timetable for Tim Stone's departure hasn't been released, and Snap says he will continue in the role to help in the search for a successor and through the company's upcoming results. Snap expects to report earnings, quote, slightly favorable to the top end of previous guidance. Netflix gained after raising prices in the U.S. for the first time since 2017. The stock was also lifted by anticipation of greater revenue. Netflix says its most popular plan increased to $13 a month as of Tuesday from $11. The shares had already been on a tear, up more than 40% since Christmas Eve, after drifting lower from a June record. And that's your Bloomberg Business Flash. Yusuf.
Thank you. Let's get back to one of our top stories. The PBOC just made its biggest cash injection on record via open market operations, pumping in around $83 billion in their latest step to prop up the economy. And the move comes before the week-long Lunar New Year holidays next month, which typically trigger a liquidity crunch, and after a raft of dismal economic data from experts to home prices. Now let's get more with Monica Malik, who's still with us from Abu Dhabi. She's the chief economist at Abu Dhabi Commercial Bank. Monica, let's jump straight into the Bloomberg and see what's happening with the Chinese yuan and a divergence that's materializing. GTV Go for our clients, a story then of a yuan pricing level and forecasts are becoming increasingly disconnected. If you could sit down with some of the key policymakers in China, looking at the data as you have, what would you be asking or telling them at the moment?
Well, I mean, I think they're very much on top of it. They've looked at the data, they've seen a slowdown, and what we're increasingly seeing is multi sort of areas of support coming into the economy. So at the beginning of the year, we had a reduction in the reserve requirement ratio to try and boost credit growth to the private sector. Yesterday, we had comments also coming out saying that they're going to look at deeper tax cuts. We've seen this liquidity injection as well. So it's a very clear picture from the policymakers that they are looking to support growth. They have seen the slowdown in economic activity, and they do want to continue the momentum. And that has supported market sentiment over the last few days.
Monica, it's interesting you talk about those tax numbers. That they're going to affect 18 million small companies yesterday, and that's what makes me think this is the A game of stimulus. Is 2019 the year in which we see the A game of fiscal stimulus, France, Italy, China, versus the central banks?
Well, absolutely, and I think the critical issue really, well, there's a couple of critical issues, is that with limited monetary normalization at the moment, there's limited ability, if another crisis happens, for the central banks to try and support economic activity, to loosen monetary policy. But at the same time, we are seeing, for example, comments out of the Fed where they're going to take a more patient view. So they don't want to tighten monetary policy to the point that it creates economic pressures, because they know that they don't have the space. At the same time, you are seeing a greater fiscal support coming in, but in many countries, debt levels have increased substantially, and the ability to also loosen fiscal policy is limited. So I think policymakers on both fronts are taking a very cautious approach. They are trying to provide support, knowing that if a crisis does happen, the space to maneuver is limited.
Yep, and keep those thoughts on debt. We're going to talk a little bit more about that. Monica Malik stays with the show. Up next, a more dovish message coming from prominent Fed officials. Robert Kaplan, Neel Kashkari, and the usually hawkish Esther George urging patience. Find out what they've had to say. That's next. This is Bloomberg. It's the City of London. You're looking at a live shot as Theresa May's deal is voted down. Have a look at the pound. It's whipsaw over whiplash. Second referendum possibly rising. We're seeing a recovery in the pound from the lows overnight. There you go in Asia. Bang, up we go. The question is, are the tail risks becoming fatter for the pound? That is the issue. Now, to JP Morgan and the boss there, Jamie Dimon is warning that record government shutdown could drive US growth to zero. He told the FT that companies are increasingly worried about the funding dispute in Washington as arguments over President Trump's border wall keep federal agencies closed. Meanwhile, we had more dovish comments from prominent Fed speakers overnight, including the usually hawkish Esther George, who's urging patience on rates. Minneapolis Fed President Neel Kashkari had similar words.
Will we actually raise interest rates twice? I don't know. It's going to depend on what the data actually comes out. Could it be more? Could it be less? You know, we'll have to see. But I'm paying attention to labor market data, wage data, inflation data. And right now, I'm not seeing evidence of pressures that would warrant raising interest rates further.
The patience bell is being rung. We'll talk about the Fed in a moment. Monica, I want to circle back. Monica Malik is our guest host from Abu Dhabi Commercial Bank. Monica, I want to talk about what Jamie Dimon referred to. Growth could go to zero on this shutdown if it extends. We're now breaking records. What's the risk here, Monica?
Substantial risks, and I think that that's the change that's happened. At the end of last year, it was very much market risks, it was uncertainty on that front, but now as we've seen a continuation in this government shutdown, increasingly it's going to be the impact of that. Firstly, you know, the Fed has become more data dependent and we're going to see delays in this. The longer the shutdown occurs, there's going to be more distortions to the data, and a protracted shutdown could lead to a different economic scenario. Economic forecasters in the US are estimating that for every month that the government is shut down, it'll shave off between 0.3 and 0.4 percentage points of headline GDP, and that'll increase the longer the shutdown it continues. So really the Fed is going to want to see the impact of this shutdown, and that's really going to determine the Fed rate hike outlook.
I mean, a lot more dovish signals that are coming from the Fed then, and then you've got the fiscal uncertainty as well. You wonder what happens to U.S. assets then. Monica, we've built a chart, put it in our library, GTV Go for our clients. This is the U.S. 10-year yield's death cross, which suggests that rates are likely to rally as potentially drops down to 2.25%. Where do you see 10-year going from here, and what happens to the greenback?
Well, I mean, I think when it comes to the greenback, again, there's a lot of moving parts because even though increasingly markets are not pricing in 2 rate hikes as they were before, we're also not seeing pressure for rate hikes by other central banks. Comments that we had recently from Draghi said that, you know, there's very limited inflationary pressure, and maybe the window that the Eurozone had is closing now for a rate hike, especially with lower oil prices, etc. In emerging markets, there's now even greater talk of potential rate cuts as we move into 2Q. So I think, you know, there's a lot of moving parts for the US dollar, but I think, you know, increasingly in the domestic economy, it's really going to be the gauge of the momentum. Again, as we started the year, there was still some tailwinds from the fiscal stimulus, but that's going to change now.
Monica, what's going to happen with inflation? I ask you because Jeffrey Gundlach popped a tweet which caught my eye in the car on the way in this morning. He went, I won't do the baby shark, but he went, and he talked about Netflix raising prices by 13%. He talked about teachers asking for pay rises of 10%. Is it the unspoken sort of bigger subject that we should be focused on in terms of inflation?
Well, absolutely, and that's going to be one of the key areas. But of course, you know, the longer the government does shut down, the more impact that's going to have on wages and employment, and that could reduce inflationary pressures. At the other side, also, you have the discussions of the China-US trade talks, and recent comments have been, you know, more positive. But again, if that deteriorates, and if you have again further tariffs being imposed, that's going to put more upward pressure. At the moment, I think there's limited upward inflationary pressure. That's also causing the Fed to support its pause view. But of course, ultimately, you know, that's going to be a key determinant for the Fed.
Monica, some great insights there. It was very, very, very good to see you. Monica Malik, Chief Economist at Abu Dhabi Commercial Bank. All right, let's check back in on the cable trade before we head out, because you had, of course, the key dramatic vote that led, of course, to the cable moving a little bit. Again, Columbia Threadneedle thinks that we haven't seen the worst when it comes to the embattled currency. Let's get you a bit of a snapshot of what's coming up. We'll talk about total Gulf issued debt, because that capped $63 billion in 2018. Turkey and Saudi Arabia are shaking off diplomatic crisis to become the first nations in the Middle East to sell bonds this year. Emirates NBD says 2019 will produce a similar number of issuances. This is 30 minutes past midnight in New York. A live shot of Midtown. Brent crude currently at $60.72 a barrel. A little bit of upside there. Remember that we are looking ahead, of course, to a key industry report that is set to show that basically there was a big drop week on week in U.S. crude inventories. In the meantime, you've got U.S. equity futures currently just barely a little bit higher than you have the S&P 500 rising above a key 2,600 level line for the first time in a month. That was in the last trading session. Currently then called 0.3% higher. A lot to digest. Remember, it's a very busy week for earnings with a close eye on what the banks are going to be doing. All right, let's check in on the first word headlines for you as well from around the world. Cross back out to Deborah Mao. Deborah.
Yusuf, Theresa May is starting cross-party talks on her Brexit deal after suffering a historic defeat in the House of Commons. She lost by 432 votes to 202, the worst result for a government in more than 100 years. The opposition Labour Party immediately called a vote of confidence, which will take place later. The UK is facing paralysis over a decision that's divided the nation and its political class for decades.
It is clear that the House does not support this deal, but tonight's vote tells us nothing about what it does support. Nothing about how or even if it intends to honour the decision the British people took in a referendum Parliament decided to hold.
Steps. And on our side, we will remain united and determined to reach a deal.
JP Morgan boss Jamie Dimon is warning that the record government shutdown could drive U.S. growth to zero. He told the FT that companies are increasingly worried about the funding dispute in Washington as arguments over President Trump's border wall keep federal agencies closed. Administration economists now say the shutdown will shave more than 0.1% off growth every week. World debt has climbed to near a record $244 trillion, more than 3 times the size of the global economy. The Institute of International Finance says the debt to GDP ratio exceeded 318% in the third quarter of last year. That's a fraction below the record 320% seen in the same period of 2016. Financial sector indebtedness rose to $60 trillion, up 10% in a decade. Consumer confidence in Australia slumped the most in more than 3 years amid pessimism over property prices and the wider economy. The Westpac Melbourne Institute Consumer Sentiment Index for January fell 4.7% from the previous month, the biggest drop since September 2015. Falls were seen across all sectors, with the largest drop in the perception of economic conditions for the next 12 months. Global News 24 hours a day, on air and at TikTok, on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Deborah Mao. This is Bloomberg. Let's get over to Juliet Sally now for a look at the markets. Jules.
Deborah, we are still lower on the MSCI Asia Pacific Index, retreating from that 6-week high reached yesterday, but only down by around 0.1% currently. So that's well off the lows when we were off by about 0.6%. You can see it's the weakness in the Nikkei really dragging on regional stocks today. That's due to that strength you've seen in the yen after the Brexit vote. But elsewhere, you have seen a little bit of a turnaround coming through. New Zealand finished higher, Australia finishing higher, and South Korea's market also stronger there. It really is, though, about the currency market. The yen higher against the dollar, against the pound in the wake of the Brexit decision. And also, Manus, we've been watching quite closely what's been happening in the yuan after we saw yet more stimulus coming through from the PBOC, this time in the sense that they added more liquidity to the system in the run-up to Lunar New Year, and also as many people face their tax bills when they take essentially a run on the bank. So adding the most in their open market operations today on record, Manus.
And look, that sort of adds to the momentum over the past 24 hours. Julia, what is the corporate side that you're keeping your eyes on today?
Well, we have seen quite a bit of weakness coming through in the metals sector today. Consumer staples looking okay. But one piece of data that we had coming through was on China home prices. Let's have a look at how some of the developers in Hong Kong are tracking in the afternoon session. We have seen a little bit of weakness coming through from some of these developers after we saw coming through China's home price growth easing in the latest sign of a slowdown. China Resources Land there, you can see, off by 3%. Macquarie Group coming through with some pretty good, interesting numbers, I should say, in terms of what they're seeing in terms of the South Korean refiners betting on a recovery after we've seen that move coming through in oil. S-Oil is one of those stocks they think could benefit. And then, interestingly, in Tokyo, Shiseido, interest in this stock in terms of investors looking on the Bloomberg for it has spiked, but there's not a lot of news behind that. We are, though, seeing a little bit of weakness coming through in some of the makeup suppliers in Tokyo, in line, I should say, with that overall downbeat trend that you're seeing across Japanese equities today. Yusuf.
Thanks, Juliet. Let's get back to this part of the world. Talk about Turkey and Saudi Arabia. They were the first in the Middle East to test the appetite for riskier assets this month after growing optimism about a slower path of rate increases by the Federal Reserve. Total GCC issuances were about $63 billion in 2018. Emirates NBD expects a similar number this year, some upside predicated on changes in oil prices. Let's bring it all together with Angad Rajpal. He's the head of fixed income at Emirates NBD Asset Management. He joins us around the set. I mean, let's talk about the Moody's line that just came through a few minutes ago. They talk about creditworthiness and an outlook for sovereigns that is stable. What are you expecting in terms of issuances then? Because the reality is it's quite a difficult market.
Yeah, I think what's really helped is the fact that last year, even despite the oil price swoon that you saw in the fourth quarter, oil prices were still much higher. For this particular year, after the $63 billion of issuances that you saw in 2018, we do expect a similar number this year. It's quite obvious that right now, as we speak, the oil prices are at $60 in terms of Brent. They'll probably average around those levels for this year. So, if anything, I think we would actually see an upside risk to that size.
How significant was it that Turkey and Saudi got their paper away, nearly $10 billion? And the Saudi pricing improved in the aftermarket, didn't it?
Yeah, it did actually. They actually left a lot on the table. It was a massive deal, $7.5 billion, very well subscribed 3 times. And it's not surprising that both Turkey and Saudi did come to the market. I mean, if you look at the emerging market sovereigns for this year, on a year-to-date basis, we are only 2 weeks into this year, and the EM sovereigns are up 1.8% for the year. So the backdrop was perfect for them to come and front-load their issuances for this year.
I mean, what basis are you using for oil prices in trying to make a forecast? I mean, ultimately, that's something that Moody's talks about as well in their latest note. I mean, are you using $60 a barrel as a basis? I mean, where are you at?
Yeah,
it's incredible volatility.
Exactly. Yeah, it's the $60 per barrel. That's where you actually expect about $65 to $70 billion in terms of issuances. And as we said, the risk is actually to the upside. So what this doesn't take into account is the fact that you could potentially have a deal from Aramco. It also assumes the fact that last year, Qatar was a major issuer with $12 billion worth of deal, and we actually don't expect them to come to the market this year.
Look, everybody must be talking about what else we can get from Aramco. Khalid Al-Falih really was tight-lipped. $10 billion is what we understand in the next couple of weeks. What does the market say they're going to come for in total?
Yeah, I would imagine, given the size of the deal, anything less than $10 billion would be a surprise to me. I think the...
But do you think they'll come for 20, 30? Do you think they're going to come to the debt market consistently?
I'm not too sure. I mean, I think it would be a combination of the loan market and the debt market. It's hard to put out an exact number, but something in the range of $10 billion is what I would expect.
Are you seeing any meaningful shift in the split between corporate and sovereign issuances, Islamic sukuk versus conventional? Or are we just sticking with what we've seen in the past? Are the trends just carved into stone? Yeah,
there's no reason to believe it's going to change massively, given that sovereigns still have a huge needs for issuances, especially in the case of Oman. So last year, I think 2/3 of the market was from sovereigns, 1/3 from banks, as well as from GREs. I wouldn't expect that to change. Even from a sukuk standpoint, I think it was comforting to see some sukuk issuances from the corporate sector in the fourth quarter, the likes of NMC, Tabreed, Senat, and hopefully we would actually see a lot more deals for this year.
And you would maintain that Abu Dhabi and Kuwait will come back to the sovereign market as well. I mean, we saw the UAE actually quite a big player in last year's bond market, but you said we're going to see a return of Kuwait and Abu Dhabi again this year.
That's right, exactly. So Abu Dhabi and Kuwait actually didn't really print anything last year. So for this particular year, we would expect about $5 to $10 billion from those sovereigns. And if anything, those should be front-loaded. So we would expect that in the first half.
What about geopolitical risks? I mean, that was a major feature of 2018. I mean, how highly does that feature in terms of the wider risk spectrum as we go into the latter part of 2019?
I think the geopolitical risk premium was attached to the deals that you saw from Saudi Arabia and Turkey. I mean, they both left a lot on the table. In the case of Saudi Arabia, despite the tightening of 20 to 25 basis points across both the tranches, the deal did exceptionally well in the long end, which does tell you that there was a risk premium that was left on the table.
Okay, Angad, thank you very much for sharing your thoughts with us this morning. Angad Rajapal, Head of Fixed Income at Emirates NBD Asset Management. Up next, Omani billionaire and super yacht maker Mohammed Al Bawani talks about demand for luxury on the water. Our interview is next. This is Bloomberg. billionaire chairman of MB Holdings and owner of luxury boat builder Oceano says the market for super yachts for the ultra-high net worth individuals is still growing. Mohammed Al-Bawani spoke to Bloomberg in London.
There's a lot of wealth around the world. There's a lot of new wealth which is all the time being built, especially in areas like IT and media and information. So there's a lot of wealth which is built in that area. I mean, just look at it. 10 years ago, there were billionaires unknown. Now there are some of the biggest companies in the world. So there's a lot of wealth which is being built all over the world.
When I think about these boats, and you've made some really groundbreaking vessels, the first super yachts with pools on board, obviously helicopter landing pads, giant, toy closets that open out into the sea. We're talking about what, $200-300 million vessels?
In that region.
And so, is that Russian oligarchs? Are they your clients? Are we talking about Saudi oil money? I mean, who's making those purchases in general?
From one time to another, all of those has been our clients. But from time to time, the sort of geography changes. Currently, the buyers tend to be American, and a lot of them are in the, as I said, media, IT, information, technology, that area. I would say a year ago, even probably the people in cryptocurrencies could have been my clients. But unfortunately, that has gone down.
Well, hopefully they cashed out in time. So you build basically the largest and most complex yachts in the world. What are the kinds of things that ultra-high net worth individuals are asking for on yachts nowadays?
I think the key issue is privacy, and a lot of people buy yachts actually for privacy, security, to be with their families, friends. So privacy is becoming a key driver at the moment. People don't want to show off. They want to be more to enjoy with their families and to get away to places where, they can be on their own.
What about the issue of sustainability? I know a lot of billionaires build yachts that also function as, research vessels. I know a lot of the super yachts are using many tons of fuel a day, and they're looking at ways to try and turn that around. Is that a concern for your clients?
Yes, the ecology is a big one. Environmental friendly yachts. For instance, I'll give you two examples. We built a yacht right now, which is based on cells, but also the cells can be solar panels. So, basically this yacht can go around the world without using 1 liter of oil or fuel. But we also have built yachts which are very fuel efficient. They are long, highly fuel efficient, environmental friendly. We've got a yacht right now, we just finished, which uses 50% less fuel than an equivalent yacht. So definitely everybody wants to be environmental friendly and eco-friendly.
What's the building process? I mean, it can't be like a car where you're churning out thousands or tens of thousands a year. They simply take up far too much space. What's your capacity for production?
Theoretically, it takes about a year to design, engineering design, and about 3 years to build. So you're looking at a time frame of 4 years for custom build. And we can build, we are building 6 at a time. So in any particular year, we'll be taking 2 new ones and delivering two new. So basically, we've got 6 in the pipeline, shall we say.
And what does your order book look like going forward? I mean, have you got people lined up to buy yachts?
Yes. I mean, it's not lined up to buy yachts, but we've got slots to build. So there are people waiting for their slots to come up.
Is there a particular place that people with super yachts like to put them in the water? Do they prefer to be based in the BVIs? Do they prefer to be based here in the Mediterranean?
The normal thing, of course, is summers in the Mediterranean, winters in the Caribbean, but also the Indian Ocean is becoming a winter play area, and there are new areas, being coming up into the market. I mean, Maldives, Seychelles, Thailand, Indonesia. Basically, these yachts go everywhere around the whole world.
What's the financing like? I mean, I'm sure a lot of these people could, if they wanted to, pay cash, or they could sell shares, but are they taking loans? Are you helping with the financing?
No, we are not, but it depends also. A lot of Americans pay cash. A lot of people from other parts of the world would like to use their private bankers, and it's not that they don't have money, but it's the interest rate. Probably they get lower interest rates, and their businesses are doing far better. So it's better to leave your money in your business, and you borrow at a lower interest rate than what you're earning, and you build a yacht.
Who's that? This is Yusuf Bakhtar.
Ahmed El Barani there, the MB Holdings chairman and owner of Oceanco. All right, let's get you a preview of what's coming up on the show. We'll talk about cracks that are starting to show in the United Arab Emirates' banking sector. We're breaking down also the signals we're getting from the property sector. This is Bloomberg. The billionaire founder of the Chinese telco Huawei has broken his years-long silence to dismiss accusations his company helps Beijing spy on Western governments. Our Chief North Asia correspondent Stephen Engel is taking a closer look at this. Steve, on the one hand, he praised President Trump, but then you've also, you also see him adamant about his daughter's innocence in Canada.
Yeah, that's right. So it was a very interesting group interview with Ren Zhengfei, the reclusive billionaire founder of Huawei. And we don't hear from him much. So when he does speak, it shows the significance of this situation with his eldest daughter, who is also the CFO, under investigation in Canada, well, by the United States, but out on bail in Vancouver. She awaits possible extradition to the United States as they look into allegations of defrauding banks in its dealings with Iran against U.S. sanctions. So Ren Zhengfei, he talked about Donald Trump. He doesn't want to necessarily antagonize the president because Donald Trump has said perhaps this case could be used as leverage in resolving the trade dispute with China. So, Ren Zhengfei does not want to antagonize him. So he said Donald Trump is a great president, but at the same time, he's saying we need to take a wait and see whether Donald Trump could actually intervene to help resolve this case with his eldest daughter. But he also went on and dismissed allegations that they are, Beijing is using Huawei equipment to spy on Western governments. He dismissed that as not true whatsoever, and that he does not talk with Beijing on a regular basis. This is what he had to say in that group interview. He says, "I love my country, I support the Communist Party, but I will not do anything to harm the world." And he went on to say that Huawei is only a sesame seed in the trade conflict between China and the United States, downplaying Huawei's role in the trade dispute.
Well, Stephen, what does the death sentence of the Canadian Robert Lloyd Schellenberg mean in China? How does it play into Huawei's problems?
Yeah, it definitely complicates matters because it's ratcheting up the geopolitical tension between Ottawa and Beijing. Of course, we've having tit-for-tat comments. Justin Trudeau saying that this sentence, which was changed from a 15-year sentence to a death sentence, is arbitrary by nature, and Canada is urging Canadians in China to use extreme caution because of what what the Canadians have called an arbitrary implementation of local laws. Well, the Chinese fired right back, saying such allegations that they're using this as political leverage is malicious slander. And the spokeswoman for the Foreign Ministry said that's like a thief calling thief.
Indeed. Stephen Engel, great reporting on the Huawei story, our North Asia correspondent. Let's shift gears a little bit to the banking sector now, because we've had breaking news from Dubai's biggest bank. They've beaten estimates, boosting full year 2018 profit by 20%. Let's get more with our Middle East finance reporter, Matthew Martin, on the story. Matthew, so the very top line, we've all seen these numbers through. Yusuf broke them. You say dig a little bit deeper and go behind the top line, and it is about the provisions in Q3 to Q4 that perhaps the market will focus on.
Yeah, I mean, overall, if you look at the annual results, it paints a very, very positive picture.
Yes.
20% growth in profit, obviously great news there. But once you start to look at some of the trends in the results, you've seen a significant ramp up in costs over the last year, despite the fact that there's been action on trying to reduce headcount in some areas. And also we're seeing as well that the provisioning in Q3, excuse me, provisioning in Q3 to Q4 nearly doubled, and that really kind of plays into this other story which we've had out today about how people are starting to get a bit nervous about some sectors of the Dubai economy and what kind of provisioning trends we're going to see throughout 2019.
I mean, Matthew, I was going to follow up on that actually, because it does tell a much more potent story in terms of the cracks that are beginning to show on some of these balance sheets, and maybe this is yet another clue in the broader weaknesses of provisions.
Yeah, exactly. I mean, you only just have to have a wander around the streets of the UAE to see that there's a huge amount of empty properties. The real estate sector, there's big exposure to the real estate sector on the balance sheet of the UAE banks. Wander around the malls, you'll see empty shops, retail, food and beverage, restaurants are really, really struggling as well. So we're starting to see, I think these are going to be the key areas kind of watch for provisioning coming onto the banks. And as well, of course, the other thing that we had last year as well, which is going to be a big negative, is the collapse of Abraj. Dubai banks have been very exposed there. There's like $1 billion of debt on Abraj's balance sheet that people are going to have to be provisioning for as well.
And that's going to come to the fore. I mean, overall, the average earnings of the top 8 banks, they're still expected to grow. It's just no longer double digit.
Yeah, I mean, look, I think, overall we're going to see a positive picture in terms of profit growth. I think that one of the key metrics to watch, though, is going to be the jaws, the distance between how much they can grow the top line.
He's been reading those HSBC. He's been reading the HSBC lives, haven't you?
Well, exactly. That was,
Is that disingenuous?
Watching our show.
that was, a key thing that Stuart Gulliver always used to talk about. And I think as well, this is going to be a key trend for the Dubai banks as well. Can they keep growing top line as well, or is where most of the growth we're going to see from taking action on costs and writing back provisions?
Matthew Martin, rolls with the punches on Daybreak. Thank you very much, our Middle East finance reporter. Matthew Martin there with the very latest on Emirates NBD and the banking. Yusuf and I will leave you with a quick snapshot of the markets because Cable's managed to undo some of its losses. We're back in the green for Cable. Go on the Cable. Are the tail risks rising in terms of second referendum or no Brexit deal? And Treasuries 271. As of course, lots of Fed voices overnight really reiterating the pause. Even Esther George getting on the pause train.
Yeah, and we had a big injection from the Chinese authorities, open market operations. We had a bit of a dip in the yuan. It's helping the PBOC in its endeavor to reduce the bank's funding costs, and it fits in with the wider theme around stimulus. The market is welcoming that. This is good news for bonds, is what the Markets Live team is writing. Currently, you are looking at U.S. equity futures that are called 0.3% higher. Remember that we saw in the last trading session a tech stock rally that came after the stimulus measures from China. We were at 2,600 for the first time in a month. Is that going to continue today? That is what it looks like at the moment. Plenty to consider, of course, across a lot of these asset classes. We will leave you with a live shot of London. Cable 128.70. Daybreak Europe is up next. This is Bloomberg.
Over 100 countries are reaching here. You ought to be there. Vibrant Gujarat Global Summit from the 18th till the 20th of January. Mahatma Mandir, Gandhinagar.
Navayuga Engineering Company, a global infrastructure giant, has created history at the iconic Polavaram irrigation project in Andhra Pradesh. A remarkable achievement and a testament to the engineering prowess which has made them set 2 new Guinness World Records title for the most concrete continuously poured in 24 hours. Navayuga also broke the existing record for the largest continuous concrete pour.
We reached 4,000, 5,000, 7,000 was India record, then we 11,000, then we 16,000, then we checked everywhere. Then we found we are well within the reach of world records. Then when we talked to them, they were quite excited, and then they showed us that there are 2 records to be broken. The good thing is both the records are broken today.
The Navayuga Engineering Company, building the future while setting new records in global engineering.
Thanks for tuning in to Bloomberg Quint. We are now truly into the earnings season, and the question on everybody's mind is whether this quarter will be or can be the quarter wherein corporate India manages to break out of the single-digit earnings growth. It's a point that's been raised once every 3 months for years now, hasn't fructified thus far. Is it going to be different this time around? Let's ask the Citi research team that's put together a detailed report on the third quarter earnings expectations. Here in our studios with me and Darshan is Surendra Goyal, the head of India research at Citi, and his colleagues Prashant Nair, Manish Shukla and Rashi Chopra. All of you, thank you so much for joining in. And really appreciate you doing this yet another quarter with us at Bloomberg Quint. Surendra, yet another quarter, more of the same, or will this time around will at least manage to meet the expectations that people have set out at the start of the quarter?
Yes, so first of all, thanks for having us here. See, from a quarter perspective, what we are expecting is that the OMCs, the oil marketing companies, will essentially pull down the reported earnings. Okay. So if you look at Nifty, ex-OMCs, we have a profit growth estimate of around 12% YOY. Again, which is also lower than what possibly was the expectation for the full year going into the year. But that's what is really pulling down numbers. If you exclude that, 12% is a decent number. But with that, it's practically no growth. So that's where we expect the outcome to be. I think what is happening in this, or what we expect to happen in this quarter, is that the top line growth will be pretty decent. So for the Nifty companies, we are expecting around 16-17% top line growth YOY. But there are, firstly, inventory losses in OMCs. That's what we expect. Secondly, autos, we expect some impact of discounting and what we saw last quarter. So margin pressures. Right. Similarly, commodities, metals, etc., we are expecting a pressure there. So when you put it all together, the overall growth still looks relatively muted, I would say.
Okay. So relatively muted bottom line growth for sure. What you pointed out the pain points. What about the larger themes, and how do you expect them to perform? Because I think a lot of what used to be consensus expectations have become anti-consensus expectations on a number of sectors. Some have moved from positive to negative, some have moved from negative to positive as well. What do you think will drive this set of numbers that will come in?
Yeah. So I think the biggest driver is financials, where we are expecting, among the Nifty names, we are expecting a 45% odd growth in financials, YOY. Now, and again, Manish is here, he can talk more about it, but one of the themes is, see, the retail banks were anyway doing well. The turnaround is starting to happen on the corporate side, and which is what is giving you this 45% growth. So that's, I think, the number which really stands out this quarter, or we expect to stand out this quarter. Because on the other side, like if you go beyond that, then staples, we expect a 14-15% growth, which is quite steady, I would say, but staples is normally very steady. Utilities is 10-12%, IT, what we had expected was 7-8%. So those sectors are anyway relatively more stable. So the outlier on the positive side, what we expect this quarter is essentially financials.
Surendra, the other thing is the report you said that you have an expectation of an earnings downgrade that would come in FY19 and FY20. The second quarter was not good at all. It was rather muted and all. Wouldn't that be priced in? The expectation anyway post the second quarter numbers would have been toned down. Yeah. So, and with 4 Nifty companies already coming out and them reporting rather muted numbers, no blockbuster, won't that be in the price already? Yeah. Won't people be expecting that this can be that?
So I think couple of questions there based on what you asked. So see, for last quarter, through the season and maybe a little after the season, we saw a 7% earnings downgrade. Yeah. Okay, so to that extent, yes, you are right, a big part got captured, but I think expectations were very elevated to begin with.
Okay.
Right? So like even after that downgrade, when I look at our bottom-up expectations, we have some 14-15% growth this year and 20% growth expectation next year. And some of the numbers I have seen on the street are even higher for next year. And to that extent, I think, yes, part of it has gotten priced in, but I think there is still room to go, because somehow the inherent assumption maybe 6 months back was corporate banks will really come back, which is happening. But then at that time, you really didn't expect that metals will be weak, there will be inventory losses, and autos will come under pressure, because that's not what the outcome was at, or outlook was at that time. So I would still think that there is some more room for the numbers to get downgraded.
Okay. Rashi, we'll talk about, he spoke about metal, he spoke about autos, and metals as one pack. And I think the consensus view is that since how the commodity prices have moved and the spreads have actually squeezed for a lot of steel companies, are you expecting the numbers to be even worse than what the street is anticipating?
See, on India, you know, the numbers in the next quarter should be worse than the numbers in this quarter. Because what we've seen is that the majority of the price cuts in steel in India came through in November and then December. And even right now, the domestic steel prices are at a premium to import parity. So my guess is we still see some more price cuts coming here. So the big chunk of the pressure effectively kicks in the Jan to March quarter. That said, I think the big surprise element could come from Tata Steel, the European business, because in their volume release, they've clearly highlighted that they've had operational issues, which is going to have an impact on the financial side. And I think that can sort of swing the estimates for the street quite a bit, because it can have a significant impact on either side.
Interesting. What else would you watch out for I think people have painted the year as to be a year of recovery for metals, but aside of Tata Steel, anything else in the metal space that you would particularly watch out for?
See, so, just taking a step back from what you said, we actually downgraded the steel space between November and December, first going to a neutral and then going to a sell on all our stocks.
Okay.
So I think that's also a little bit of a non-consensus of sorts, where basically we think that the China property market is likely to see some decline in the starts, and that's going to have a follow-through effect into India. In any case, Indian steel prices are at a premium, and Indian valuations don't stack up particularly attractively versus the global peers. So, aside from the quarter, I would anyway keep watching out for the China trends. On the non-ferrous side, we've also seen like a fair bit of weakness across the commodity prices. What we need to watch out generally for is what's going on in, the recovery in the aluminium market, like the alumina refineries, etc., which have closed globally. And if we see some sort of an improvement based on, what happens in China over there. But effectively, I think at this point in time, there's really little to look forward to on a positive basis on the metal side. That's what we think.
So either earnings nor stocks, look at them too positively. Okay, you're contrarian on another basket as well, which we will come to in a bit. But taking the conversation to what Surendra mentioned, the largest pack and what could happen there, what is your estimate? I mean, Surendra gave the headline numbers, Manish, but what's the thought of what will lead the performance and what could be the outliers that you may be contrarian on in terms of earnings delivery in this quarter?
So this quarter, I think we need to separate financials as banks and non-banks, because non-banks will have their own pain points. But if you see at banks as a group, I think across the board we'll see good earnings, because growth at the system level is coming back. There is some growth momentum. And because of a liquidity tightness, there is some pricing power with the lenders. NBFCs are largely out of the market, PSU banks are out. So the banks who have the ability to lend are able to price it well. The challenge is on the liability side. Across the board, if you see, deposit growth for the private sector is fairly muted. So I think growth coming back is a big theme. The other key variable in the quarter is the portfolio gains on the GSEC book.
Sure.
That will be fairly substantial, as well as write back of provisions will be large, because almost the entire first half loss has been reversed in 3Q. Right? Many of the larger banks might use that to cushion their NPA provision coverage, but nonetheless that can help boost your overall earnings. So I think banks as a pack should report pretty good numbers. Obviously, there will be some provisioning required towards ILFS related exposure, but that is specific to banks and not systemic in that sense. NBFCs, I think we will see moderation in growth, as well as at least a 10 to 30 bips sequential margin contraction. Right? Now that is where the commentary is very important, because our interactions seem to suggest that as far as disbursements are concerned, December was more or less back to normal. But do they really taper down growth going into next year? Because many of the NBFCs, the way they were getting priced in earlier, we were factoring very strong earnings CAGR for many years to come. And this was a really large liquidity shock which came in, right? And we are in a seasonally tight environment for liquidity. February, March seems to be, always is very tight for liquidity, and hence RBI is doing a lot of OMOs to kind of preempt it. So I'm saying that's how you will relatively look at it. Corporate banks in general ought to do well, because A, the growth is picking up, and B, provisioning sequentially should be lower. While still it might be a bit elevated compared to historical standards, but most of the NPA recognition is largely done. And even if you look at the RBI financial stability report, they themselves have brought down their NPA expectations for March 19 by almost 150-200 basis points. Right, so stress is lower, only some bit of provisioning needs to be done. Focus would be on growth. Where is growth likely to come back? Does it come commensurate with margin and fees as well? I think operating profit growth related commentary will be very crucial for banks.
In the stocks that you've said that you are looking at as a positive commentary is ICICI Bank, and on the negative side it's Edelweiss. Can you give us the rationale why are you also positive and negative on Edelweiss?
No, so ICICI specifically because we believe there is NPA recoveries coming in, which will help them cushion their P&L, and growth momentum is picking up. For banks like ICICI and Axis, they have a favorable ALM in terms of a floating rate asset book and a reasonably large retail liabilities. So in a rising rate environment, your margin should kick in. Edel specifically, and I mean that would hold true for most of the NBFCs who have a decent wholesale book, that sequentially you will see growth moderation as well as margins under pressure. I mean what applies to Edel is true for most banks, most NBFCs who have a wholesale exposure and margins coming down.
Will it be bad for housing finance companies as a pack? Because what the entire issue that panned out, the NBFC crisis and the inventory levels, that was there in the second quarter, but was not factored in. The results that came in did not factor all that.
Sure.
That is yet to come in this thing. Will it be really bad for HFCs this time?
So HFCs, it's interesting, right, that retail home loan sales momentum is really not picking up. We are like in the same position for almost 3-4 months now. But the bigger HFCs who have had a long, strong parentage, I think they have been able to still raise money at cheaper prices relative to other HFCs. But wholesale across the board, as in be it construction finance or LRD, would see moderation, be it large HFCs or small HFCs. So you're in that sense right that earnings-wise it may not be great, but I think some of it is already there in stock prices. Question really is, will it be materially lower? And that will be a function of what is the outlook or guidance that HFCs come out and paint.
Okay, interesting. We'll talk about some specific pockets as well, but would want to get in Prashant into this conversation as well. I'm sure Darshan would have a lot more questions, but just an initial thought, Prashant. The headline numbers, Surinder indicated that you are contrarian on the space. What about the quarterly delivery of some of the companies?
Yeah, so it's very difficult to draw a common thread across all pharma companies because it's so bottom up depending on specific products. So as usual, I mean, we think this will be another quarter where trends will be quite mixed. Management commentary has been cautiously optimistic over the last couple of quarters, and I think that will continue. Overall numbers should be okay because we are coming off a low base. Fiscal 18 was a very bad year. But specifically, we expect 2 or 3 companies, mainly Aurobindo Pharma, Apollo Hospitals, Cadila, to have good numbers this quarter. And the rest of the pack would be, I don't think there'll be too many surprises among the other companies.
I think the trend, another interesting trend that's been spotted is the hospital space. Obviously, Apollo seems to be doing extremely well, even if you see the stock prices thing, but the other hospital space aren't. So will Apollo continue to be a leader in this segment, and do you expect with the capex behind them that earnings growth over the next few quarters will keep on getting stronger and stronger for them?
Yeah, so it's largely a function of where you are in terms of your own capex and bed utilization. So Apollo has is done with its big capex, and they've had investments in a few areas which where they are seeding businesses. So all those investments are behind them, and we are beginning to see utilization improve. So that phase normally lasts for 3 to 4 years is what we have seen in the past. So we don't see why it should be any different. They still have enough capacity and they don't need to add fresh beds. So we think that that phase of margin expansion will continue, and probably this quarter we think it will be a positive surprise, primarily because usually the December quarter is a seasonally weak quarter, and that seasonal weakness will still be there, but because Apollo is coming off a base where there are significant losses in businesses like AHLL, which is their retail initiative, and those losses are coming off, that will help offset the seasonal weakness to some extent. So in that sense, we think QOQ numbers will look much stronger than they usually are. So I think that could surprise positively this quarter.
Okay.
Interesting.
The other one is obviously Sun Pharma. What are you investing? What are you telling your clients to do on Sun Pharma? Because right now there are a lot of negative news that are coming in, which are not related to the financials, but the corporate governance issues of this thing. What are you telling them? And on the earnings recovery, do you see that happening anytime soon till the time the specialty business kicks in?
Yeah, so earnings, our sense is, and while they don't split the specialty spends separately, but if you basically make some assumptions around that, the core business seems to be now fairly steady and maybe improving a bit. Halol is no longer a bottleneck for approvals. Price erosion has normalized, so the core business seems to be okay. Specialty spend will continue. We don't think that will ease off. So to that extent, numbers will be subdued to some extent. On the stock, it's a bit difficult to take a firm. We have a neutral rating at this point in time. We've had that for some time. You're right. I mean, some of the noise, particularly around the so-called whistleblower report, is difficult to analyze because there's not much clarity on what the contents are. So what we are essentially telling investors is, look, this is what the business is doing. And to that extent, post the correction, the business does not look very expensively valued. But there are these factors which we don't have much visibility on. Until you get more clarity there, it's very difficult to really take a firm call on how that could impact the rest of the business. Is it just noise, or could it be tangible enough to have an impact on how the business moves going forward?
Okay. Well, we'll talk about cement, we'll talk about some specific banking names as well, but Surendra, a couple of pockets with you. Firstly, a space that you track at the back of your hand, IT. Now, while the Wipro bonus announcement would have gotten that stock excited and TCS raising the guidance would have gotten that excited, the margin performance for the two majors that have come out thus far were not the best. What's the call here? Would there be margin pressure seen across the space? Incidentally, a mid-cap IT company that came out with numbers also wasn't the best performance. Would there be margin pressures across the space? Which are the names that you would watch out for the most?
So I think, margin pressures have been there for many years now. Okay, so I don't think really anything has changed. I remember in our sector downgrade in 2014, which is way back, one of our key arguments was the sector will not grow as profitably, or profitable growth will be more difficult to achieve than what investors are expecting. And that has not changed. So if you see, there are a few things going on at the same time. Firstly, there is a big part of the business which is the legacy or the traditional business. There is always pricing pressure on that. And then the new business, which is the digital business, as companies call it, that requires a lot of investment, right? And when you put it all together, then it essentially becomes a currency call. The year we get a 8-10% rupee depreciation, things look okay, which is what last year was. If you don't get that, then you will start feeling the margin pressures again. So when we wrote our outlook this year, early January, we actually said that we expect margin pressures to become tougher, worse. Because in addition to the medium-term headwinds that I spoke about, there are two things which one needs to keep in mind. Firstly, the US visa situation is not easy. Okay, like when you talk to companies and talk to sector participants, renewals is a challenge. Okay, costs of doing business in the US are going up. One of the large companies actually in their commentary said that cost increases in some of our key cost of doing business in some of our key markets. So that is already happening. Secondly, on the India part of the supply, what happened is these companies, most of them were very focused on improving utilization for a 4 or 5 year period. And suddenly what we have seen is in the last 6-9 months, these companies have all started to hire. And when all of them do it at the same time, it creates supply pressure here also. So which is where we think, and our house view for this year is a broadly stable rupee. With a stable rupee, I think you will continue to see margin pressures. If you get a 7, 8, 10% rupee depreciation like you had last year, then some of that can be hidden. The other way to look at it is even last year, look at any company, just do a YOY comparison, and you will see that the gross margins have gone up only a little bit, if at all, despite a 10% rupee depreciation, right? Which kind of tells you that the pressures on the business from a margin perspective are still very much there.
Okay, so in which case, what would you believe would happen to these companies in terms of the earnings delivery and going ahead? I mean, Infosys has kind of raised the guidance a bit. Are you optimistic on that vis-a-vis TCS, vis-a-vis HCL Tech and others? Yeah. And broadly, if you have some mid-cap IT companies within your coverage, because a lot of disappointments are coming through. Persistent, promising for a long time. Finally, the street seems to be giving way. Mindtree, there could be some reshuffle on the promoter side. Any thoughts here?
Yeah. See, firstly, from a sector perspective, our earnings are generally 5 to 15% below consensus. Okay, so that even in stocks where we have a positive view, we might be actually slightly below consensus. And that too is, as of now, we are still assuming 71.5 on the currency. Okay, so that's something to watch out for, because if you actually get 70, then our numbers could actually get revised lower. Now, within that framework, Infosys was a top pick going into the year. In fact, we had upgraded it some time back, and it was a top pick primarily because what we expected is they are, over the last year or so, they have really been investing in the business. Okay, the deal flows were all visible. Last 2 quarters were very strong on deal flows, and we were expecting a revenue acceleration. And the starting point on valuations was quite comfortable. Like Infosys at parity to the market, it's a bellwether stock at parity to the market, 25-30% discount to TCS was a good starting point. Okay, so while our sector outlook, what we mentioned is sector, we remain cautious. Okay, we are worried about the sector, but within that construct, Infosys looks like the best idea. So which is why we are still positive on it, and what they delivered on the revenue side, it was a beat and raise. right? Margins, they have pressures, but I still think that in FY20, margins, they may be relatively better than others because they have been investing a lot. And as some of those investments start yielding results and normalize, you could actually see them do better compared to others on margins. And which is why relatively we are most comfortable with Infosys at this point of time on the large cap space. Mid caps, I think they're the kind of situation we are in where the rupee support may be less, at least that's what our view is. And you have supply side pressures both from India and the visa situation. Generally a tough place to be in. Okay, and you would have seen last year some of these mid caps had a great year, right? Because the leverage works both ways. Last year they benefited more. Stocks were like at really low valuation start of the year. Like L&T Infotech, which is a top mid cap pick, did what, maybe 80% or some number like that last year. Huge returns. Now going forward, our view is one has to be selective. Near-term returns could be muted. But the only mid cap in my coverage, which I am still kind of saying that, yeah, this is a good story medium term, and we continue to like it, is L&T Infotech. Okay, so other names, again, you have like, so Persistent, we have been generally negative for the last 2-3 years. Our concern has been, despite the company kind of making that initial move into digital, they have never been able to benefit out of it too much. And there have been margin pressures. Right, Mindtree, we liked it for a bit and then we kind of downgraded, but there, of course, the other part apart which you mentioned in terms of the change, even on the business, there is a lot of growth which comes from shorter cycle projects, right? And that's a part of the market whenever you are concerned about the global macro, you start getting concerned about short cycle consulting kind of projects. And where Mindtree's dependence in our mind is possibly higher than some of the larger companies. So which is why Mindtree, we have a neutral for now, Persistent, we have a sell, but we are very selective in the mid-cap space.
Okay, I was very surprised to see that you all have a little contra view as far as cement is concerned, because across the brokerages, if you read, most of them have written cement off because the main reason they say is pricing power is not there. What's your expectation and why is Ambuja something that you all like?
So on the quarter, not so much to expect even on cement actually. So we saw a really good 1Q, then we saw a disappointing 2Q. And what's happening in this quarter, so it appears that the industry demand growth is somewhere between 7 to 8%. Okay. Pricing should be more or less flattish to slightly lower. What we figured is that prices improved in the northern India, prices fell in southern India, and was largely range bound in the rest of the regions. What we were looking forward to is cost benefits kicking through with the, with the fall in crude petcoke prices. But most of the cost benefits should come through again in the fourth quarter. So from a quarterly result perspective, we don't really, we expect a slight decline in the EBITDA per ton actually, except maybe for Ambuja, which had gotten hit quite badly in the last quarter on their other costs, maintenance costs, etc. But the contrarian view really comes from the fact that, we're of the view that cement demand growth is likely to outpace supply growth. I mean, there can be a lot of concerns, there's elections, we don't really know what's going to happen, but effectively whatever government comes in place, we will see a constant focus, on this whole housing sector, the rural sector. We've seen this whole kickoff coming through in the Prime Minister's Awas Yojana program, etc. So I do believe that, that demand growth should continue. And while difficult to really say what that actual growth number would be, our view is that supply growth is likely to be somewhere around 4% per annum. So demand should most likely outpace that. And in an improving utilization environment, prices should start moving up. Again, one can argue that, demand has been strong and we haven't seen that price increase coming through. One of the reasons was that we were dealing with distressed M&A, that there was some capacity which was operating at low utilization levels, and after having been acquired by the larger players, we've seen the utilization levels move up and therefore more supply come in. And I don't really think we have a lot more distressed M&A that's left, which would come and spoil the pricing environment, so to speak. So therefore, I think that pricing should kind of improve as utilization levels improve. Second thing is that on the cost side, like I mentioned, like the next quarter probably costs could go down by about 100 to 150 rupees just purely on diesel or on petcoke. So we actually like the sector. Even on, one can again, there's a lot of questions on valuations, etc. And to your question on Ambuja, ACC and Ambuja are two stocks which trade at around replacement cost at the moment, right? So if we get a price hike in cement, I actually think the upside could be more for these stocks than the others, simply because the market hasn't really appreciated the fact that there hasn't been any growth in these companies in the last many years, whether it's capacity growth or volume growth. But in the last year or so, what we've noticed is that this, the group, the Lafarge Holcim group, has focused on volume growth. They have focused on costs, and very recently they have announced growth capex, capacity additions in both the companies. So it kind of shows that there's a limited reason for why that discount should be, so wide, and therefore that should start narrowing down.
Okay.
On the flip side, if we were in a scenario where we don't see price increases, if that scenario were to play out, given where valuations for these companies are, one is they are at replacement costs. Second, even on consensus estimates, they are both trading at about 1 standard deviation below mean on EV/EBITDA as well. So the downside is kind of protected on both these stocks.
Let me step in here. I think the easiest way to see this is last year, everything that could have gone wrong went wrong.
Okay.
Be it pricing, be it raw materials which went up, and valuations corrected. Okay, and right now when you obviously talk to investors, everybody is very negative, as you rightly said, right? But we see a lot of comfort from a downside perspective, given that a lot of negatives got priced in and valuations are where they are. And at least when I wear my strategy hat, like when 1 year back or 1.5 years back, when we were asking people to buy Apollo hospitals, for example, we used to get similar pushback because at that time things were really going against them. We think that that valuation support is there. You see a little bit of a fundamental improvement, and given the ownership expectations, etc., this sector could be one of the better performers this year.
Okay, that's very much. We're just about out of time, but Manish, just quickly, a minute answer. We dwelled into what you want or what you believe ICICI Bank, etc. could do. Just 1 quick minute on the corporate-facing large PSU banks. What do you expect this quarter? Are you bullish on the SBIs, BOBs of the world?
No, so large PSU banks, again, in fact, if you've seen, their NPA recognition was ahead of private banks. So they are in a situation where they are likely to see recoveries. But because PSU banks, as of last quarter, were carrying very high liquidity because their LDRs are low, their gains on treasury book are going to be very large. I think that will really skew the financials for the quarter in a big way. But I am sure that NPA recoveries for corporate PSU banks would be at par or better than what you would see for an ICICI or Axis, because they were earlier in the cycle in recognition, right? And incrementally recognition is lower and lower. So to that extent, in case of Bank of Baroda, no matter what the quarter says, questions will be around the merger, right? So that is a big event that people are talking about. How does that play out, etc.
Okay, we'll watch out for all of these. Rashi, gentlemen, thank you so much for taking the time out and being with us today on this broadcast. And from Darshan and me and the team that put this show together, thanks so much for watching.
Delegates of over 100 countries, 15 partner countries, 10 partner business organizations are uniting on a global stage. They will also witness the India's biggest trade show, new opportunities for trade between Gujarat and Africa, Ahmedabad Shopping Festival, MSME Seminar, Futuristic Technology Exhibition. Watch the unfolding of Gujarat's future in Sprint 2022 and experience much more. Welcome to the 9th Vibrant Gujarat Global Summit, 18th to 20th January, Gandhinagar.
Navayuga Engineering Company, a global infrastructure giant, has created history at the iconic Polavaram Irrigation Project in Andhra Pradesh. A remarkable achievement and a testament to the engineering prowess which has made them set 2 new Guinness World Records title for the most concrete continuously poured in 24 hours. Navayuga also broke the existing record for the largest continuous concrete pour.
We reached 4,000, 5,000, 7,000 was India record. Then we 11,000, then we 16,000. Then we checked everywhere. Then we found we are well within the reach of world records. Then when we talked to them, they were quite excited, and then they showed us that there are 2 records to be broken. The good thing is both the records are broken today.
The Navayuga Engineering Company, building the future while setting new records in global engineering.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here. There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that will sustain.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We're getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Technical analyst NS Fidai, Aditya Agarwala of Yes Securities, and Amit Shah of India Bulls Ventures join me on the show. Thank you to all of my guests for joining me. Before we start the show with our experts, let's go across to Yash Upadhyay, who has a chart on Escorts. Yash, what does this chart indicate?
Afternoon, Darshan. So a sell signal coming in on Escorts, and there's a formation of a bearish engulfing pattern. So on the back of not so very heavy volumes, the stock is down significantly today. The big red candle over here that completely engulfs the one ahead of it. And an interesting point to note is that even after going higher in the previous day of trade, it managed to fall because at higher levels it is seeing some resistance. The stock has seen a spectacular rally going from the levels of 600 to as high as 775, and from these levels it is sort of seeing pressure. And on the back of the bearish engulfing forming, we could expect a downtake when it comes to Escorts.
Okay, and Yash, if you backtrack, every time a bearish engulfing pattern was formed on Escorts, what was the average return that it gave?
So Darshan, 5 out of the last 7 times the bearish engulfing pattern has formed, the stock would have given you on an average returns of close to 4% over the next 10 trading sessions.
Okay, so that's fair enough. Escorts at 742. Thank you so much for that, Yash. NS, Escorts at 742.
Yes, absolutely. The stock has been moving in very small candles, like they were more like you can say it's a distribution pattern, and yes, it can fall almost up to 700 rupees also. So agree with him about it's in bearish this thing. It may see a sell off.
Okay, what about you, Amit?
Yes, see, the overall trend is strong, but just today, the momentum just for the near term is kind of losing out, and the 20 EMA on the 60 minutes chart, where it was continuously holding, has given up as we speak. So yes, a move towards 705 to 710 is likely. A small trading correction.
Okay, what about you, Aditya? Would you agree?
I would say it's a small trading correction, as Amit pointed out. So I'll closely watch it for 740 levels. That is a good, strong support for the stock. If that is taken out, stock can go down to levels of 720. So fresh short will be triggered below 740 for targets of 720. A little bit correction can be seen.
Okay, so it's more of a technical correction that our experts say, and you can play Escorts for that level only. But we'll start with the first round. NS Fidai has a bullish call on Dredging Corp. Fidai, what's your strategy? What is the indicator that you've used for this strategy?
I have kept it very simple today. If you see this pink line, that's 200 DEMA. Okay. That is 200 days exponential moving average. The stock had rallied strongly from around 340-ish, almost up to 460, 465. And in that too, in two trading sessions, and then it has consolidated well. And if we add volumes, if we see volumes here, the volumes are exponentially high, while now it has, in this correction, it is a time correction rather than price correction. It has formed a flag, a triangular flag here, and the volumes are also subdued. So that shows the smart money has tried to remove the weak players. The smart money entered when this rally happened, and it took resistance around 200 DEMA. After that, when there was a minor correction, and it is holding out within this mother candle. If you see this, the price has not closed below this. So currently today also it is showing some strength, and only if it closes or starts closing below this, then there could be some opportunity for us to buy on bit lower. Otherwise one can buy above breakout of this area. So that would be around 460-ish, 465. And it has a potential to show 500, 550 also.
Okay,
on the upside.
At this level, should they buy or should they not buy?
They can buy this at this level because this is very low risk area. Here, if you see this is the stop loss just below this for trading purpose. So one can buy here and keep a minor stop loss around 435. Okay, and they can go long here.
Okay, what's the time frame of this trade?
Time frame could be like moment it gives a breakout, this 500 could happen in probably the way it is shooting up, it can happen in a day.
Okay. So that's a positive view that's coming in. That's a potential 10% upside. Thank you so much for that, NS. Amit, would you buy Dredging Corp? Would you share the same view?
Yeah, I would share the same view. In fact, basically this is a very, very strong stock, and a few sessions back, the kind of move that happened probably on 31st of December, I mean, it says that very strong hands have actually started to, corner the stock basically. So, and the way it's been consolidating, and then So since then is, it's a very tight consolidation. I would actually look either ways. Either I'll look, so it's a buy basically in either ways. So I'll buy either above 460 or even on a dip towards 430. I would utilize to buy the stock basically.
Aditya, third 3 and 3. It's not yet broken out, as NS pointed out. It's yet to break out. So if I buy at current levels, my target out here will be 470. 470 happens to be the simple 200-day moving average. He talked about exponential day moving average. So simple 200-day moving average is around 470. If it crosses 470, then yes, stock can head to levels of 550, 570 as well. So if I buy at current levels, my immediate target will be 470. Above 470, I'll hold on for targets of 550. There's a bullish momentum building up, no doubt about that.
Okay, no doubt. Dredging Corp is the first stock that we spoke about. Positive views coming in. The next stock that we want to talk about is Axis Bank. Amit has a recommendation in it. It's a short-term flag breakout. Explain the chart and why are you so bullish?
Sure. Can we have the monthly chart first?
Yeah. Okay. Okay. I don't think we have it. We'll try to get it, but
no problem. Yeah. So Axis Bank is one of the banks, one of the private banks, which has not actually in last 3 years or something of that period. If you see, it has not really participated with the Bank Nifty. So in a way, it has underperformed, but that underperformance is likely to catch up.
Yeah. Is this the one?
Yes.
Yeah,
correct. Yeah. Yes. So basically, this is a long-term period where Bank Nifty rose very sharply. A lot of banking stocks have done well, while Axis Bank was going through its own period of its sideways consolidation, which is actually it had already broken out. It was again testing the zone. It has again started an up move. So overall, it's actually breaking out from its long-term consolidation. And generally, such long-term consolidations do not end easily, and they tend to have bigger moves. So we have been recommending Axis Bank for quite some time to our clients. We have an upside target of 850 on a little longer horizon. But yeah, so basically the view continues. Axis Bank breaking out of its monthly consolidation is a very, very bullish signal, and this is happening, along with the market itself doing well. So there are good chances of basically this trade working out. Now, if we can have the intraday chart, the 60-minute chart. Yeah, so even on a near-term basis, as I said, if we are looking at a near-term trade, it is actually in confluence with the direction of the market trend itself. The move preceding to the consolidation is very, very important. If you can see this sharp up move, it has come in very few sessions, and then again a tight consolidation. Tight consolidation is very, very important, which says that the holders are quite confident about the stock, and it's a flag breakout. So one can expect a sharp up move on the upside.
What's the stop loss that one should keep?
1 second. The stop loss is 649, and we have targets of 730 and 750 on Axis Bank.
Okay, thanks so much for that. So Axis Bank is something that we'll talk about. Aditya, Axis Bank, what's your view?
So I would want to buy and hold it in the portfolio. It's, as Amit pointed out, it's breaking out of a long consolidation on the monthly chart. But as far as a very short-term trade is concerned, I'll put a stop at 650. If the stock starts to trade below 650, I'll be out of the trade, because there can be some profit booking that can be seen in the stock because of the nature of the stock has shown recently. So from a longer-term time horizon, yes, I can include the stock in my portfolio even at current levels. If it's a very short-term trade, I'll put a stop at 650 and then go long at current levels.
Okay, Fidai, what's your view?
Yeah, it's a bullish stock. It's in breaking out in the lifetime high zones, and it is trying to enter into uncharted territory. Bullishness would come into the stock once it is above 700, because that would take away all the bearishness from the stock, and it could be a good portfolio stock also.
Okay, so that's the view that's coming in on Axis Bank. Positive views coming in. The next stock that we want to speak about is Info Edge. Aditya wants to speak about it. No doubt the counter is trading at record highs currently. Will the momentum continue?
Yes, Darshan. So if you take a look at the stock right now, it's broken out of an ascending triangle pattern. As an ascending triangle pattern is basically the highs are the same. If you take a look at these two candles, the highs were the same, and the lows keep on rising. So we have the higher lows and the highs were the same. And in trade today, it's beautifully broken out of that consolidation pattern. Volumes have been pretty healthy in the recent breakouts. And along with that, if I take a look at the RSI continues to take support at the 50, which is the neutral level. It doesn't go into the bear zone at all. So it takes support at the 50 level on all declines that the stock has seen, and from there stock and RSI tends to go higher, price tends to head higher, head north. And also if you take a look at the history of the stock has a history of going into a narrow consolidation and then it breaks out, and then again it goes into a narrow consolidation and it breaks out. So in trade today also it has done that. It is broken out of that ascending triangle pattern. I expect the stock to test levels of about 1830 to about 1820 to about 1930 in about 1 to 2 weeks time horizon. I would put a stop close to about 1590 for this play.
Okay, so that's a positive view that's coming in. Thank you so much for that, Aditya. Amit, Info Edge, would you be a buyer?
Yeah, so see, basically the stock has been in range between 1700 and 1350. So it's a broad range that the stock is moving in, and it is just giving an early indications of trying to break out above that. So once it sustains above 1710, 1715, then a breakout is definitely on the cards, and then a move towards 2000 can and should be very much possible. Of course, it should take maybe probably 2-3 months or something for that kind of target to achieve. But yes, that momentum is building up.
Okay, broadly positive. NS, what's your view?
Yeah, absolutely agree. Stock is favorite of mine. The way it is trading, it has not. It has made sure that it has tested 200 demo almost 4 times in last 6 months. True. And now also it is now trading in a flag pattern, trying to give a breakout. Today also there was a good move, but you would see momentum only above 1750, because that is where there is lots of selling pressure coming around 1740-ish.